Now, it's often the case that when you're faced with too many choices, you struggle to make just one. Like, for example, when you enter a departmental store looking for biscuits without knowing which one to get. That's called the paradox of choice, and that is true also for mutual fund schemes. Let's talk about a couple of schemes so that you know what they're about and you know whether they work in the requirements that you have for them. Santosh Navlani, the Chief Operating Officer of ET Money, is joining me now. Good evening to you, Santosh, and thanks so much as always for taking the time. Let's talk about aggressive hybrids as well as balanced advantage funds. They've emerged as popular categories, particularly BAFs as they are called. What are they?
So, Alex, both these categories, aggressive hybrid and balanced advantage fund, one can safely say are one of the better ways to asset allocate one's money into two asset classes at once all the time. So we can compare both these in a very nice manner. So let's understand these in a bit detail. If you look at aggressive hybrid category, is one of the oldest category of mutual funds. This aggressive hybrid category actually means that as per SEBI regulation, the scheme will allow you an exposure into equity from 65% to 80%, depending on the market. The fund manager may decide to choose towards lower end of the 65 or can go towards as high as 80 as well in a very favorable market as well. Or sometimes the market may be cheaper and the fund manager may hike the allocation. So what this category actually does is a very regimented way of booking profits. So what happens typically is when an investor invests into equity fund, he or she may continue holding it for a while, and there may be a market cycle that the investor may not have been able to take advantage of. The fund manager in an aggressive hybrid category, because he or she has to maintain only between 65 to 18 equity and necessarily at least 20% has to be in debt securities. What will happen is when the market actually bounces a lot or has a very big rally, the equity allocation may actually go towards upwards of 80, and fund manager will regimentally book profits and get it back to as high as high as being only 80, maybe lower at times. So what happens is a retail investor may typically don't know when to book profits. So aggressive hybrid category actually is auto rebalancing category, where at any point of time you will always be having a range of 65 to 80. Helps us cut down the risk in turbulent markets a lot, and over long periods of time, a dash of debt into a full equity portfolio does a lot more to your gains than actually a full equity portfolio in isolation. So if you look at long-term performance of this category, you would actually see some of these funds have actually beaten Nifty or a typical large cap returns over long periods of time with a very less volatility compared to a full equity fund. Compared to this, if you look at a balanced advantage fund, they are actually like aggressive hybrid, only difference being they can go as low as 30% in equity at times and can go as high as even 100% equity in times. So they are more of opportunistic funds. They run based on some kind of models depending on the AMC, and they allocate between equity and debt typically in very unbiased manner depending on market scenario. So they typically, most of these balanced advantage funds will buy at the lows, sell at the highs, and give you very favorable risk adjusted return where risk may be quite less compared to even aggressive hybrid category, but returns may be similar to aggressive hybrid category in the long run. Though sometimes if you compare year to year, depending on the rally in the market, you would see aggressive hybrid being sometimes above balanced advantage being above aggressive hybrid in a turbulent market. So over long periods of time, both these categories are like really good categories for people to consider as their core portfolio needs.
I want to talk a little bit more about the balanced advantage fund, because I think a lot has been said over the course of the pandemic about balanced advantage funds. Would you say that one of the key factors associated with the BAF is the ability to protect downside and to curb downside risk? How does that work?
Yeah, I think that's one of the primary reasons they are also finding a lot of favor in the investor community. And at ET Money, we've personally been a very big proponent of this category of funds to drive into investor segment, only for one reason. It actually helps you protect downside most of the times, and also helps you basically overcome the emotional fear sometimes that you may have in investing during turbulent markets. So let's take an example of pandemic itself as we can relate to it better. So in March 2020, when market was falling like a knife, almost 38% correction in a very short period of time that we saw, very few people would have actually had ventured out or had a courage to really start their equity investments, or probably double down their equity investments, or maybe kind of add to positions in that sense. People may not have done that. Some people would have done, but most people would have not. And now imagine they had a balanced advantage fund in their portfolio. What would that have done? The fund manager, because it doesn't, he or she doesn't act in a biased manner, he or she would have actually allocated more to equity, moved money from debt, so equivalent to like fixed income or equivalent to like FDs. They would have moved money from fixed income instruments or any other category like arbitrage to equity and taken an advantage of the low prices to build equity positions. And the moment market recovered, say towards June, July, they were slightly cutting down the exposure and trim down the exposure and book profits as well in a very regimented manner. Again, when you look at most parts of March of 2021, the market actually has been a very bull run kind of phase. But for last 6 to 9 months, market actually has not gone anywhere in the index terms. They actually have been very smart by cutting down exposure and only having about 30 to 40% allocation of equities. So what it does, basically, it not just helps you cut the downside, because when the markets are rising, the upside is capped, downside can be risk higher. They cut down the equity exposure, give you debt exposure. And when markets are cheaper, they actually help you overcome the biases, take positions in equity, and actually give you advantage of buying at lower prices. So they are like all weather funds, if I can say that. They should be part of the long-term proposition. You would not typically find them giving you really good returns in short periods of time, and they should not be considered for it as well.
A follow-up on the Balanced Advantage Fund, because I'm trying to understand in the current context also, you have a significant amount of volatility. So I'm sure you've done a little bit of peering into the portfolios that these funds have to look at where the equity allocation is, where the debt allocation is right now. So give us a sense. And also, when it comes to the equity allocation, since these are actively managed funds, do fund houses have different approaches as to at what point do they start booking profits? Are there parameters that govern when they start doing that?
Yes, Alex. So on the first question, you answered that because of in the current market volatility, how the funds have been behaving. So if you look at February and month-end disclosures of the fund houses, you typically find most of the balanced advantage funds actually in the range of 27 to 35 equity allocation. But if you look at the February end or early March kind of portfolios of these people, most of the funds actually would have hiked their allocation towards 40 and maybe higher. We would know the March end allocations in first week of April, but it's safe to assume that if January end portfolios had about 35 and February end at about 40 because of market volatility, chances are very high most of the funds in the month of March end would probably have about 50% allocation. So what it does, the market actually became volatile. It gave you a lot of opportunity to buy cheap. They actually hiked allocation to you for the people who may have missed the opportunity to buy these buy good stocks or something like that. People in this fund would have actually benefited. And in the aspect of the models, so most of the funds actually have their own in-house models. Most of these actually have a mathematical driven kind of quant strategies. Some of these work on a mix of PE ratio, price to equity ratio, price to book ratio. Some people look at interest rate scenarios also in the economy. Some of the fund houses would probably look at even the technicals and the technical chart kind of levels from perspective of overbought markets or oversold markets, or even look at short-term and mid-term moving averages. So they're very, depending on the fund house, they will have different models. Broadly, there are two kind of classification of models, if I can say. Some are pro-cyclical. Basically, these funds not necessarily cut exposure when the markets are rising. They will probably try to play with the rally. Like Edelweiss Balanced Advantage Fund is one of those unique funds where they typically buy as market is trending up and they sell as market is trending down. So the same approach that they would actually participate when there is a risk on mode in the market so that they can benefit from rising prices. And when the risk off mode comes to the market, they cut down equity exposure. So they use a mix of what they call pro-cyclical approach and and fundamental based approach as well. Whereas most of the other funds in the marketplace would actually have P ratio, interest rates, PB ratio, other kind of fundamental lit parameters, domestic flows coming in or not coming in. So they will basically apply those models and see whether they can cut down risk. So ultimately, both the classification, if I can select pro-cyclical and fundamental, and other only fundamental, they would only be working towards cutting down the risk. And in the long run, both work out fine. You need to pick up what model you can get attracted to or you feel is more suitable to your investing style and pick that up. Ultimately, because asset allocation between equity and debt is driving the returns and risk cut down in the portfolios, the stock picking may not add too much value in those in these funds. So stick with the model and continue for long term is how I would put it.
Okay. Now, I want to talk about both of these in conjunction. You talk about aggressive hybrid and you talk about BAF. Since we're talking about them together, they are both hybrid, but they are very different from each other as you've described. One is quasi-equity and performs a certain role, whereas the other is more suited towards risk mitigation, if I understand correctly, and correct me if I'm wrong. How would you use them in your portfolio? What purpose would they serve?
So Alex, actually, if I will look at both these serve different needs kind of a user, of an investor in that sense. So aggressive hybrid, they are like as a quasi-equity portfolios, quasi-equity funds, because they can be as high as equity, 80% in equities. And most of the funds have typically maintained at least 70 to 75 in equity all the times. Because these funds don't typically take a market view that market is overvalued, let me cut down exposure beyond a point. They would want to participate all the time. So a 70-75% equity exposure at any point of time in the marketplace, depending on, irrespective of the condition of the marketplace, typically suits a more aggressive investor who's looking to invest for really long term, like 7 to 8 year period, maybe at least 5 years period, because they are typically equity investments. So if I were to look at kind of investor, a slightly more aggressive investor should be putting money in aggressive hybrid, and a slightly more conservative or a moderate investor should be putting money into balanced advantage funds. So that's where the comparison with respect to risk profile of the people ends with. But there are kind of, portfolios where you would say that I actually I can be better off by taking a large cap exposure of my portfolio by buying a aggressive hybrid, and then I can actually supplement a balanced advantage for my long-term needs in terms of actually asset allocation, which is automated and I'm not deciding the what portion of my portfolio should be in equity and what portion of could be in debt. And I don't want to take headaches of rebalancing every month or calculating the tax impact of that stuff. So both these suit different kind of investors and needs is how I put it. And to each his own, I would suggest, depending on the scenario, you should be investing in these funds.
For example, if you were talking about balanced advantage, then, in a conversation I think we've had in the past about goal-based investing, where you're saying that even your long-term goals should have an element of debt, element of equity. It should have you should have a portfolio-based approach even for those goals. Perhaps one of these, the balanced advantage would work towards a long-term goal as well if you have that kind of an outlook. And you've established that it requires a bit of a long-term view when you're investing in these two funds, right? Yeah. From the tax perspective, I think you raised a very important point, right? Which is when you're switching between the two, big advantages that you don't have to book capital gains or capital losses, or particularly capital gains, and that's a huge advantage. But what are the tax implications of these two?
So an aggressive hybrid fund is always by definition an equity taxation, Alex, because as per income tax rules, any fund having at least 65% allocation towards equities all points of time in a financial year gets classified or gets equity taxation as a benefit. So these are always taxed as equity funds, and you would typically pay only about 15% short-term capital gains tax if you were to book or sell these funds within 1 year of purchase. And if you sell beyond 1 year, then a long-term equity taxation gets applied, whereas in which you basically get up to 1 lakh rupees of capital gains, long-term capital gains are tax-free. And an excess of 1 lakh rupees, you pay 10% tax on your profits. So these are typically equity funds. Most of the balanced advantage funds are also classified as equity, because what fund managers do to give you equity benefit or equity taxation benefit is they take whatever the shortfall of from 65% is there into their funds for equity allocation. So for example, if a fund has only allocated 40% to equities in a month, they would apply or allocate rest 25% to reach 65 into arbitrage opportunities, which are again very low risk kind of investments in that sense, and typically have a short-term debt or liquid fund kind of returns for the portfolio. So balance advantage funds typically put money in that and also qualify for equity taxation. Some balance advantage funds don't take arbitrage opportunities and they prefer buying full debt instead of that. And in those cases, you would have to really look at rely on the fund manager to guide you whether at the time of you selling the fund, would you kind of will be able to take advantage of an equity or a debt taxation. So it depends on the fund to fund, and you have to go and check with your financial advisor or with the fund manager itself. So that's fun. But one thing which we can probably also look and value add to the investors is balanced advantage funds are more suited for lump sum investments compared to an aggressive hybrid. So if you're somebody who is willing to and are not somebody who can do SIP because you are not a salaried individual, you have not predictable cash flows, a balanced advantage fund suits you far better, because typically what happens if you invest lump sum, you'll always look at market levels and decide, should you buy right now, should you hold on for a few months. So balanced advantage funds take away that question forever from your mind, because they would typically be having more equity when markets are more supposed to be more favorable in the future, and they will be less equity when markets are overvalued. So you would basically outsource that thing completely. So if you're a lump sum only investor, a balanced advantage fund may be suiting your needs far better.
Absolutely. And I think going back to the start of the program where I said you need to understand what you need, well, hopefully we've done that, Santosh, and we've told people why they would need either an aggressive hybrid or a balanced advantage fund. Thank you so much for taking the time. Always a pleasure.
Thanks.